in US dollars.
Right.
Maybe I 5x over collateralize it. Maybe I 10x. If I, raw Bitcoin is like 1-to-1. It's like if I have $1 of Bitcoin, I have $1 of Bitcoin. If Bitcoin trades down 50%, I've lost half my money. But if I 10x over collateralize something, I have $10 of Bitcoin. I have $1 of stretch. If Bitcoin trades down 50%, I still got $1 of stretch. If Bitcoin trades down 90%, I still have $1 of stretch.
Bitcoin, says Saylor, is a high-performance, long-duration capital instrument. It behaves like a 20-year investment. Volatile, yes, but historically appreciating around 50% a year over long time horizons. It's the raw commodity of digital finance. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
Kerosene represents most highly refined crude oil. It's pure liquid energy, right? It's jet fuel. You put it in rockets. Like, you can't refine oil more than kerosene. So it's an important metaphor. It's the cleanest, highest grade distilled liquid energy, like pure grain alcohol, right? Like, that's what you're talking about there, from a bunch of potatoes, stack of potatoes, and out comes pure grain alcohol. The equivalent of kerosene in the Bitcoin industry is a Treasury preferred credit instrument like Stretch. So on one side, you have digital capital, Bitcoin, and Bitcoin is a long duration, volatile, high energy, high performance source of capital. Long duration, think of it in terms of like 240 months, like 20 years. You should, if you want to get the optimal performance, you can hold it for 20 years. Like, it's a 10 to 20 year type investment.
Right.
High volatility, right now it's about 45 vol. Implied vol, it's been 50, it's been 60, it's been 70 vol. And high performance, appreciating 50% a year.
Right.
So that's the raw commodity. What happens if I strip away the volatility, strip away the risk, strip away or compress the duration, translate it to a given currency, and extract the yield? Right? That's what a Treasury credit instrument or Treasury preferred is. So that's what Stretch is. The idea is you build something that's got 1 month. Like, I'm going to give you 10% dividend yield for 1 month. Like, the duration is 1.
Yeah.
The yield is 10%. The currency base is US dollars.
Right.
The spread is like, if the risk-free rate is 400 basis points, and that's like a 6%, 600 basis point credit spread. I've extracted a 600 basis point spread for the next month in US dollars.
Right.
Maybe I 5x over collateralize it. Maybe I 10x. If I, raw Bitcoin is like 1-to-1. It's like, if I have $1 of Bitcoin, I have $1 of Bitcoin. If Bitcoin trades down 50%, I've lost half my money.
Right.
But if I 10x over collateralize something, I have $10 of Bitcoin. I have $1 of stretch. If Bitcoin trades down 50%, I still got $1 of stretch. If Bitcoin trades down 90%, I still have $1 of stretch. The statistical odds of Bitcoin trading down 90% are like point something, right? It's a small percentage. So by over-collateralizing, you strip away the risk. By structuring it to adjust, if you put a set of adjustments or representations below par, below 100, you start to strip away the volatility on the downside. If, like with Stretch, what we did is we put in a call option at 101, and then we told the market we're going to sell it actively at 100 or better.
Right.
And then we also told the market we're not going to sell it below 99. And if it's below 99, we're going to raise the dividend.
Right.
Okay, so you're kind of collaring this instrument. And then the last point is we created a preferred instrument where we pay it monthly in cash, and then we adjust the dividend every month. So it turns out if you scan in the history of preferred stocks or the history of the credit markets, no company has ever issued a preferred stock where the management has discretion to adjust the dividend every single month. Like, there are some preferreds that are floaters where they set the credit spread at 350 basis points over SOFR, and they will float with SOFR with the risk-free rate. And there are a lot that are fixed where you set it at 7% and the principal will trade up and down if SOFR falls or rises. But the idea that the credit spread is completely variable is a new idea. But by the way, not a new idea in the world of credit, because who does this? Well, nation states do it.
The Fed.
Literally, that's what a central bank does, right?
Right.
That's what every central bank does. They set the interest rate on their currency.
Yep.
What we did
To
was
keep it
just
stable.
copied, traditional bankers, and we set the interest rate on our currency, which is stretch. So that is the kerosene of the Bitcoin, treasury company, or of the digital assets industry, because it represents the greatest degree of financial engineering. Just like kerosene represents the greatest degree of petroleum engineering, right? I've done the most refining. I've distilled the highest quality product. You could imagine, for example, you could extract the same product in yen. So I want to create a yen instrument that's 10,000 yen that pays, a monthly yen cash yield or a cash dividend. I change that every month. And now I've created the equivalent of kerosene for the Japanese market. And of course, what does everybody want? Everybody kind of just wants, I've got some money I need to park for the next 90 days. If I put it in the bank in Japan, I get 50 basis points or less. I put it in the bank in Switzerland, I get minus 50 basis points. If I put it in the bank in Europe, I get 200 basis points or less. If I put it in the bank in the US, I get 400 basis points or less. And so what I'd like to do is put it in some kind of structure where I'm going to get my money back in 9 months or 6 months or whatever. The principal's not going to move around, but I'm going to get 10%.
Right.
Everybody wants a bank account to pay 10% instead of 4% or
They
2% or 0%. And so I think the most interesting product that you can create, the most interesting digital credit product, is a Treasury preferred credit instrument for corporate treasurers or for retirees, right? Just,
Right.
And how big is that market? It's like $30 trillion in the US.
Yeah.
Of just short-term Treasury money. So 30 trillion in the US that's getting paid SOFR.
Yeah.
And the opportunity with digital credit is you create a company, you hold Bitcoin, that's digital capital, you start to issue credit instruments on top of the capital, and you can decide how much risk do you want to strip away. Is it a BTC rating of 2, which is 2 times over-collateralized, or is it 10?
Right.
Right? 2 is less risk stripped away, 10 is more risk stripped away. Strip away the amount of risk you want, strip away the amount of volatility. The smaller the instrument compared to the overall collateral pool, the less the volatility. And then there are a lot of terms and conditions that you can put in the instrument that would constrain the volatility. So you decide how much volatility and risk you want to strip away, you decide how much yield you want to give it. You decide whether you want it to be in pounds or Canadian or euros or yen or whatever, and then you distill out, you extrude the yield and the pure, boost over the risk-free rate, and you offer that to the marketplace.
Yeah.
This represents a new degree of financial sovereignty. Corporations could manage yield dynamically, responding to market changes in real time, something unheard of in legacy finance. In Saylor's view, this is the kerosene of Bitcoin finance, the most refined, optimized, flexible form of monetary energy.
The capital markets is 99.9% of the companies are locked out of them. Right. So the first question you got to ask is, how come there's 40 million businesses in the United States, but there's only like 4,000 publicly traded companies?
Right. So don't have access to the capital.
Okay, so it doesn't sound like a help. Like if I said only 4,000 companies have telephone and internet access and the other 40 million businesses don't, what would you say?
Yeah, that'd be a problem.
What if I said 4,000 companies have bank accounts and the other 40 million don't?
Right.
So you just start with the observation that the capital markets can't be all that effective if 99.99% of the companies can't access them.
Right.
And beyond that, the other observation is if you look at the companies that are in the public market, if you look at the thousands of publicly traded companies, it's like 20 that control all the attention.
Right.
And most public companies are zombie companies. They're uninteresting. No one cares about them. They carry a huge burden of regulatory compliance. And they don't get the attention they deserve. So one could characterize the capital markets as being unwieldy, ineffective, right? And it's, and what is that? They're 20th century instruments that never really evolved in the 21st century. You got to ask the question, why does it take 3 years to raise money? If you have a small business, why can't you do it in 3 days?
Right.
Why does it, why is it impossible to take custody of your own stock shares? Why is it impossible to trade shares on Saturday afternoon?
Right.
Why is it impossible to transfer things globally? Why is it that you can actually take $1 million of cash and get paid interest on it, but you can't take $1 million worth of stock shares and get paid for that? So there are all these things that just are very inefficient that we just take for granted, but they don't work very well.
Right.
Highly regulated industry, progression stops.
Right.
The banking, if you look at the credit markets, they seem to be stuck they're stuck in a mode that was probably modern 30 years ago. Like they're 30, 40 years old and they haven't advanced. If you look at the equity markets, it's the same way. For example, my company came public in 1998. We traded on NASDAQ from 9:30 in the morning till 4 in the afternoon. The year is 2025. We trade on NASDAQ from 9:30 in the morning till 4 in the afternoon.
Right.
What's the difference between the way my stock trades today and the way it traded 27 years ago?
Yeah.
Nothing.
Yeah.
Right. Could you imagine any other industry where there was no material change for 27 years? The traditional finance industry is highly regulated, and it has settled into a comfort zone. And the forces of progression are in the crypto industry. Most of the forces of the traditional finance industry are forces of regression. Like that, the knee-jerk reaction is, why shouldn't we do this? Why is this a bad idea? If you listen to all the Gensler speeches for the last 4 years, it's always why this is a bad idea.
Right.
Like, why can't I issue a token, for my small business over the weekend? Well, we got to protect the investors.
Right.
Okay, so that's why we're going to disenfranchise 40 million companies from being able to raise money, because the people that might want to invest in them might not be qualified to make that investment. So it's kind of like, well, why don't we give cars to people below the age of 60? We've got to protect the pedestrians, or protect the, it's like if you took that rule and you applied it to phones or cars or websites or flying in an airplane, we would have no automotive industry. We'd have no aircraft industry.
Right.
We'd have no telephones. We have nothing, because we wouldn't do anything until we were sure that no one would be harmed by the doing of the thing.
Which is impossible.
We wouldn't even have fire. Wouldn't want someone to get burned. We wouldn't have electricity. People might get shocked.
Right.
Got to protect
Yeah.
got to protect the people that might get hurt by the new idea.
Yeah.
So that's pretty much the existing status quo in traditional finance, and it has been for 30 years.
Yeah.
So while the crypto industry drives the forces of progress, traditional finance remains stuck in regression, protecting the old system at the expense of innovation. And that's why the Bitcoin financial ecosystem, with its open access, programmable assets, and global liquidity, will eventually outcompete the legacy banking system.